The United States Treasury is sued again for Tornado Cash sanctions. Did the merge make Ethereum less decentralized? And although CPI data came in hot and tanked the market, at the end of this video, I'll show you comments from the FOMC meeting that had some traders feeling optimistic. My name is Morgan, and this is your nightly crypto news wrap-up. Let's get it. Welcome to BitBoy Crypto, the people's channel, home of the BitSquad, the largest and greatest crypto community in all of the interwebs. Smash that like button and don't forget to hit subscribe to get in on the latest crypto news. The United States Treasury is the subject of another lawsuit, and for good reason. Crypto nonprofit Coin Center is suing for sanctions put on Tornado Cash, saying the Treasury overstepped its authority in banning the protocol. We know the mixer was used in many high-profile attacks to launder funds, but no matter how you slice it, enforcing sanctions on privacy just isn't right. Coin Center wants Tornado Cash delisted from sanctions because banning a protocol without public process is not a path that we should go down. After all, if Tornado Cash can get banned, then what's stopping Bitcoin or Ethereum from being added to the sanction list in the future? Sanctions on Tornado Cash have already caused problems for DeFi platforms, stablecoins and staking pools, and some of the Circle's USDC holders had accounts frozen because of misguided compliance measures. According to the executive director of Coin Center, Jerry Brito, this just cannot go unchallenged. Just last month, Coinbase funded its own lawsuit against the Treasury Department for Tornado Cash sanctions, also alleging that the Treasury overstepped. Now let's do a quick check of the market with Frankie Candles.
Thanks, Morgan. All right, guys, let's jump in and do a little market watch here. We've got Bitcoin coming in at $19,385, up about 1.1% on the day. Ethereum coming in at $1288, down about 0.5% on the day. Now, guys, I do want to bring you to the Bitcoin chart real quick. Now, we did see the volatility we were looking for today. We knew it was going to be a wild day with the CPI report coming out, and it wound up absolutely dumping. We broke our value area low, which was our key level we were watching. Broke it, bounced off the spider line, perfect bearish retest, and a dump down to about 18,125 before getting a strong bounce back into the value area. Now, I've been talking about this a lot on my channel, and it was one of the reasons why one of my key levels I was watching was this spider line, because we've actually seen this happen many times before. Every time in the recent past, when we broke our value area low, we wound up finding support, coming back into the value area, getting support on that value area low, and working our way towards the POC. You saw it happen again right here. We broke down, came back up, caught support on the value area low, came back up towards this spider line, and you see it happen here one more time. You come down, get support, come back up, right? And then you come down, you come back up, and then you see it right here again. You break down, bearish retest, find some support on the spider line, you come back up. So this was one of the situations we were prepared for, and we did have a very similar story play out where we broke down. We did not bring any new volume in on the volume profile, making it likely that we get sucked back into the value area, and now we are back inside on our way towards that POC. And real quick, guys, we are putting bearish divergences in on the 15-minute time frame with momentum coming out and money flow coming out, so a cool-off period would be likely in the immediate short term. If you guys want to learn more about technical analysis and how to trade crypto, whether the price is going up or down, you could check me out on YouTube at Frankie Candles or at Frankie_Candles on all socials. Back to the news.
Thanks, Frankie. You know, you can trade like Frankie by using Femex, and you can get a sweet sign-up bonus by clicking the link in the description. A report from Morgan Stanley published Wednesday showed that Ethereum became more centralized after its merge to proof of stake. Now, we don't need a big investment bank like Morgan Stanley to tell us the facts. They've done some research, but let's face it, big banks just don't understand crypto the way that we do. This Morgan right here can tell you the problem of centralization and what we think of as decentralized crypto are well known. With big players entering the space and barriers to entry becoming higher, the problem only gets worse. 65% of Ethereum nodes are cloud hosted, with half using Amazon Web Services. So if cloud providers have severe outages or decide to censor participants, decentralization goes out the window. Add to it the fact that 60% of validators are managed by only 4 companies. As we know, centralization is a security risk because requiring unconnected validators to agree on a transaction is what made networks harder to hack. Even decentralized autonomous organizations, or DAOs, have become more centralized, with Uniswap DAO recently voting to establish a foundation that would include a management team, advisors, and a board to manage its budget. Gone are the early days of home computers mining most of the cryptocurrency, making way for companies and large holders to take over. Ethereum blocks used to be validated through mining or proof-of-work transactions, but now they're validated using proof of stake, which requires an upfront investment of 32 ETH. At Ethereum's current price of just under $1,300, owning 32 of them can be out of reach. Among other issues, this creates an environment where there are fewer validators. We can't get totally nostalgic for Ethereum mining though, because mining rigs were a barrier to entry as well, and big mining pools also compromise decentralization. This morning, CPI data came in hot, indicating an 8.2% increase in September year over year. The price of Bitcoin tumbled 3% following the news, breaking below $19,000. Minutes from yesterday's Federal Reserve's FOMC meeting told us to expect more of the same, rate hikes and economic tightening, but notes did include one shot of hopium that caused the S&P 500 to gain a little ground before getting pushed back down again after consumer price index numbers were released. In the notes, it said that Fed meeting participants agreed that inflation isn't going away and that it's taking a toll on lower-income Americans. They stressed the need for a more restrictive policy stance to stabilize employment and prices of consumer goods. Translation: more rate hikes. One comment did stand out as potentially positive, though. Meeting minutes said that several participants remarked that in this uncertain financial environment, it's important to mitigate the risk of significant adverse effects on the economic outlook. Which is corporate jargon for, how about let's not put the world into a global recession? After all, the United Nations recently warned the Fed and other central banks that rate hikes could dramatically affect the world economy. No matter how you look at it, the money was printed and the damage has been done to the economy. Inflation numbers are controlling the markets right now, and that means we probably have a long wait ahead of us until the crypto markets start to recover. But hey, at least we're in it together, BitSquad. That's all I got. Have a great night.